Welcome to This Week in Money. I'm Jim Goddard. Today, CIBC Wood Gundy's Ross Clark discusses sell in May, go away. Could giving the banks back to the people solve our economic problems? Webofdebt.com blogger Ellen Brown says yes. And AddictedToProfits.net's David Skarica believes Russia and Greece could be hot for profits. We'll talk to Ross Clark right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600. Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark, investment advisor at CIBC Wood Gundy in Vancouver. Welcome back to This Week in Money, Ross.
Always a pleasure.
We're going to kick off the show with a little theory, Dow theory, and how it's playing out in the markets right now.
Okay, theory. When some of the market's moving up and the rest isn't, one has to be a little concerned. When the market's breaking out, one also wants to be just cautious at that point because clearly you want to see momentum continue to grow. And we have had growth in momentum for the last 3 or 4 weeks now since the credit markets turned and we started to see the high yield aspect come into play. And with that, we've seen the Dow Industrials move to new highs, the S&P move to new highs, the same thing with the Russell, and we've got NASDAQ testing the levels back in 2000. What we don't have is the transportation index managing to put in a new high. It's been over 8 weeks now since both the transports and industrials were at highs, and when we start to see a divergence where the one of the two indices, in this case the transport, is failing to confirm the industrials, it puts up a red flag because we've got maybe 8 examples in the last 30 or 40 years where we've had divergences that have stretched over more than 6 weeks, and now we're at 8 weeks. And if that divergence stays in place, if we were to see the Dow roll over, the industrials, the probability then is that you get an 8 to 9% minimum correction in the market, and it, in a number of instances, has been quite a bit deeper. So what I would suggest for the traders out there is that you keep the stops back at about a 2-week trailing low. So look at the lowest price the last 2 weeks and don't be willing to risk anything beyond that.
What's happening with gold right now?
The gold market is still trying to turn the corner off a bottom, but it's made a couple of attempts here. We're now doing a pretty good job of holding around the $1,200 level. And what's, I think, significant is that the miners have been doing fairly well, coming off for the last half a dozen days to the upside. So quite often the miners lead the turn. And I would once again, as we move into March can be a reversal month for precious metals. The last few years, we've seen rallies into what I would call the Ides of March, sort of between that 8th of March to the 20th. And I would say that if this rally takes hold right now, might look towards something in the 1250 to 1260 range as a resistance level during March. If it can't get off the ground here and we start to slip, probably if we were to close through the 1190, you're probably going to spend the next couple of weeks after that searching for a lower support area.
Is the sell in May and go away theory going to work?
Well, the go away in May, as far as I'm looking at it, the equity markets have had their classic move out of the October bottom. But I'm a little cautious that we would at this point have, if we pause here in March, I think you could end up with a reasonably deep correction. The go away in May, I would say only if we haven't corrected. If the market has gained some momentum from where we are right now and keeps going, then you think about the go away in May.
People are taking a look at the marquees at the local gas station. The price of gasoline has jumped dramatically, even though the crude oil price hasn't. We're kind of in a perfect storm situation, I think.
Oh yeah, we've got some difficulties with the refinery. Now you've got we're coming into this changeover in terms of the seasons. Typically, the January-February period is where you want to be looking at buying the unleaded gas. We take a look at the UGA, which is the ETF for that. This thing's gone from just under 30 a month ago to now pushing the high 30s. So it's having its seasonal play quite nicely, and is independent of the oil market. Oil having trouble getting through that $54 level. And as we said, oil likes to create these double or triple bottoms over a period of months. And so for now, we know where the resistance is. It's 54. Support's down at the 44 or 43 and change level. So, probably a good chance of testing that lower level before things are over.
I was wondering earlier about transportation stocks and lower energy. Has that had an effect?
Well, I mean, it had the initial impact, and this is one thing you see when you get that hard break in the oil market, such as we had in the fall, well, right into the end of January. The hard breaking period in the initial phase tends to be very good for the transportation stocks, but as you then get stuck down there at these lower levels, you tend to see them peter out. Now, we've had some of the truckers have done exceptionally well. You've got some of the rails that have working back towards their highs. But airlines fairly choppy in here. They pretty much topped out a better part of a month ago.
And of course, the airline business depends on how well the economy's doing. When people have lots of money, they don't mind paying high fares.
Oh yeah, I mean that's name of the game, But they're hitting them everywhere. If you're taking that extra piece of luggage or even one piece of luggage now, other than a carry-on, they're starting to charge you for things.
Ross, thanks a lot for chatting with us.
And we will talk to you soon.
My guest has been Ross Clark, investment advisor at CIBC Wood Gundy in Vancouver. If you have any questions for Ross, you can email him at ross.clark@cibc.ca. Coming up, Ellen Brown on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Ellen Brown, author and editor of the blog webofdebt.com. Comments can also be found on her website, ellenbrown.com. She's also written several books, including The Shocking Truth About the Money System and How Can We Break Free. It's called The Web of Debt. You can find it on Amazon, and she's also written 10 other books on fascinating topics. So again, if you went to Amazon, I'm sure you could find them for sale or where to go to find them for sale. Ellen, welcome to This Week in Money.
Oh, thank you.
Ellen, one of the things I want to ask you about is in California, you're feeling so strongly about the banking system and how it seems to be set up to rob innocent citizens of their money that you'd like to see some major changes in the California banking system, and you're willing to go into politics to do it?
Well, I did run as a Green in the last election for state treasurer. And, of course, I lost, but I did get more votes than any other third-party candidate. But, I got some entrees to politicians, so there's still hope there. I'm still working on that. A state-owned bank is what I'm working on.
And why would you like a state-owned bank?
Well, we have one state that has such a thing, a state-owned bank. That's the Bank of North Dakota in North Dakota. They're the only state that escaped the credit crisis. Totally, like they never went in the red. They have the lowest unemployment rate in the country. They have the lowest default rate on credit card debt. They have one of the lowest foreclosure rates. Forgotten what else, but anyway, they make 1% loans. The Bank of North Dakota makes 1% loans to startup farmers and startup businesses. They make 1% loans to school districts. Whereas in California, the school districts are so strapped for funds that they've caved in for these capital appreciation bonds where they're in 40 years, when they actually have to pay them off, they'll wind up paying 10 or 15 or 20 times what they got in principal. So the worst is like 2,000%, which is terrible, but they've been strong-armed into these things, or I think seduced into them, because they weren't really told what the consequences were. But anyway, in North Dakota, they make 1.7% loans to students. They can do all that because of their banking model. The Bank of North Dakota, by law, all of the state's deposits are deposited in the bank by law. It was set up as a DBA of the state, so it's set up as North Dakota doing business as the Bank of North Dakota. So it's hugely capitalized, got a huge deposit base, and then it can do what all banks do, which is leverage its capital backed by its deposits, and basically create money on its books. Virtually all money is created by banks today, created as a loan, but because they're all private, they create it as a loan, and they expect to have as much back as they put, or as much back in interest as they put out in principal on a 30-year loan. So where's the interest supposed to come from? I mean, it's an unsustainable system. It's sort of parasitic, where they're always sucking more out than they put into it. But a state bank works the other way. They're publicly owned. Their mandate is to serve the public, and they spend their profits back into the economy for things that the people need.
So it actually sounds like a big savings and loans, or what we have in Canada, credit unions.
Yeah, except a credit union is or both of those are private, and they're still competing with other private banks, and they just don't have the strength of a state bank. Is backed by the state because it's owned by the state. So it basically that overcomes the capital requirements. The Bank of North Dakota partners with the local banks. So the local banks do all the work, really. They go out and find the clients, and they're the ones with all the branch offices and the tellers and so forth. And the state bank is really a wholesale bank that just partners with the local bank, helps them with capital, helps them with liquidity, but basically stabilizes the whole system. They didn't get into the subprime crisis because they didn't have to sell off their loans to investors. They could keep them on their books because the state bank helps them with capital requirements, etc. Many advantages.
And of course, here in Canada, there's a lawsuit underway where people are asking, can the Bank of Canada become the property of the people again instead of belonging to the 12 biggest banks, with a chairman appointed by the government to basically go along with what the big banks want them to go along with. So,
right.
That sentiment is out there.
Yeah, That's the Comer lawsuit, or the Committee for Monetary Reform.
Right, so you're very aware of that.
Yeah, actually I spoke at one of their meetings once, and I've written for their magazine they've posted my articles quite a few times. Any
hope that it'll go through?
Well, I think, recently they had what they called a win, but it was really a win preventing the whole thing from being dismissed on the pleadings. So what they managed to do, I think the damage claim was dismissed, but they still have the case for declaratory relief. So they want a declaration that the Bank of Canada can do this and they should do this, and that's their mandate to do it. Whether they could actually get them to do it, I don't know.
One of the reasons we're talking to you today is concern over so-called bank bail-ins. If a major bank gets into trouble, they can go and rob your bank account to solve that thing and to keep them solvent. What's your position on that? Should banks be able to go in legally, both in Canada and the U.S., and take a certain amount of money out of your bank account, like happened in Cyprus, the thing they call the Cyprus haircut?
Right. They absolutely shouldn't, but they can. It's legal, apparently. It was formalized last November when the G20 leaders met in Brisbane, Australia, and all shook hands on it, probably not even necessarily knowing what they were shaking hands on. The thing was called it was the Financial Stability Board's Adequacy of Loss-Absorbing Capacity of Global Systemically Important Banks in Resolution. Now, even from the title, would you know what that was all about? But what it says, and what has been agreed to, is that if the too big to fail banks become insolvent, because they're too big to fail, they can't be allowed to fail, and the governments have gotten tired of bailing them out. The taxpayers don't want to bail them out anymore. So instead, they're supposed to save themselves by recapitalizing themselves with their depositors' money. And apparently they can do it because legally, when you put your money in the bank, it becomes the property of the bank, and all you have is an IOU. You're a creditor of the bank. So they're just giving a haircut to their creditors. But we saw what happened in Cyprus. All the depositors over 250,000, over 100,000 euros, the insurance limit, lost half their deposits. So these were largely local businesses because they're the people that need to keep a lot of cash so that they can pay their workers and buy supplies and so forth. So they need a lot of liquidity, and that's why they have these big bank accounts. And some of them had to shut down, or they laid off a lot of employees. I mean, it was terrible on the economy, a terrible result. So it's actually worse, I think, than bailouts, because a bailout, it's just like a tax, and okay, so our taxes might go up, but we'll probably survive it. But if they took your deposits, if you happen to be in that bank that went down and they snatched your deposits or even half your deposits, you could be wiped out. You might not be able to pay your mortgage or your rent or whatever. So, terrible thing. But it is looking like it's happening.
In the U.S., why don't they just bring back the Glass-Steagall Act that kept investment banks separate from the ones that handled your day-to-day banking?
Well, that certainly would be a good idea, and there's a lot of push for that in Congress, but there's also a lot of pushback because people say, well, it can't be unwound now. The whole derivative thing is too big, and it depends on the banks, now that they've commingled the deposits with the investment wing, the investment part is allowed to use those deposits. Like all the money goes into one pool, basically. And then they can use that as collateral for their derivatives bets or their repo bets or whatever. And that's the problem, is that all this collateral is used more than once. It's rehypothecated, as it's said. And in the U.S., the 5 biggest banks have a derivatives exposure of nearly $300 trillion. And they only have, one of those banks would have maybe $1 trillion in deposits. So, and under the Bankruptcy Reform Act of 2005, derivatives go first in a bankruptcy. So they will take everything. And, if it was a big derivatives bust, they could wipe out the whole trillion. There wouldn't be anything left for the FDIC, which is, the U.S. insurer of deposits. And it wouldn't even be anything left for the state and local governments, even though they think that they're collateralized.
Is there any way for a person to protect themselves from being part of an involuntary or bail-in?
Well, theoretically, you could move your money put a safe in your wall somewhere and move your money there, but it's hard to write checks against the money in your wall. I mean, you'd have to trot down to the electric company every month to pay your bill. So you do want a checking account somewhere, but what you should do, at least, is only keep the money in the bank that you really need for liquidity purposes, and ideally not one of the too big to fail banks. Although the problem is that the whole banking system is one system. They put their money in Wall Street in overnight sweeps in order to make a little interest overnight. And if they go bankrupt, it's going to be overnight. So there goes your money. Somebody told me that a good place to put it was Scottrade, which is an investment house, because they're not connected to a bank. They just hold the money there. I mean, not that you buy stocks with it. Just put your money there and open an account, buy a little bit of stock, and all the rest is in cash. But then you have the problem, you still probably can't write checks on it, not very easily.
Well, I wonder if the banks are allowed to take money out of your account in bad times, how come they're not putting a lot of money in your account during good times? And a lot of them have just posted record profits. Yeah,
no, that's the problem. Because they pay us, Chase Bank, I know, is now paying 0.1% interest on deposits, and I think that's actually term deposits, not, I don't think they pay anything on your transaction account. So 0.1% means that if you put $1,000 in there for a year, they'll pay you $1 on it. And because of that mere dollar, they call you a creditor, because they say, see, you knew you were taking a risk. That's why you get paid interest. You don't get paid interest for nothing. So you're a creditor, and we can take it.
What about the European banks? A lot of central banks there have negative interest rates. They charge you money for putting money in the banks, and their excuse is we don't want people hoarding money.
Yeah, well, that's an interesting development. I know the Swiss are doing that, and they really don't want these, the Russian oligarchs and all the people trying to hide their money in offshore tax havens. In fact, they've gotten in trouble for that. So they really don't want those extra deposits, and they don't need the deposits. The way the banking system works now, they just borrow it from each other or borrow it from the money market.
I still wonder why credit card rates are so high when the banks themselves are getting money for nothing in the U.S. and in Canada for less than 1%.
Yeah, and credit cards are another thing altogether. They don't even involve deposits. They just advance credit. So yeah, that's a definite ripoff or moneymaker for them. One problem is that those big credit cards are so well established. If you want to join in that, like let's say you set up your own state-owned bank and you wanted to have a Visa or a MasterCard, you still have to pay the 2% or whatever it is that you pay to the other end of the, I think I don't remember what it is, but a certain percentage at each end. You have to pay that anyway to join their system, and if you start your own card, it's going to be so obscure you probably can't get anybody to take it abroad. But yeah, it's a definite scam, and it would be great if we, the people, could develop our own credit card system. Yeah, I know in Costa Rica, 80% of deposits are in publicly owned banks, and they actually do use credit cards, like Visa-type credit cards, but they return the profits to the bank, which is basically, because it's government-owned, it means the profits go back to the people.
The question posed by your book was the shocking truth about the money system and how we can break free. How can we break free?
The problem is that virtually all of our money today is created by banks when they make loans. And so we could either take back the money power the way the lawsuit against the Bank of Canada is suggesting, which is to borrow from their own central bank, which means effectively interest-free, and of course the central bank creates the money on its books. Or you could issue the money directly. The federal government could. Our Constitution says Congress shall have the power to coin money and regulate the value thereof, which many people interpret to mean they have the power to issue the money. Or even if it's just coins, you could issue a $1 trillion platinum coin. I wrote about that before. So you just put your $1 trillion coin in the bank, and now you've got some money in the bank that you can write checks against, you, the government. But the most feasible thing to do is, because it's very hard to get our federal government to do anything, particularly in terms of monetary reform, so the most feasible thing to do is to approach your local legislators, your state legislators or your city or your county, and try to get them to set up their own bank, like the Bank of North Dakota. And then, like all banks, they too can create money on their books, but the profits and the benefits go back to the people.
Ellen, again, maybe outline some of the websites people could go to find out more about this subject.
My blog is at ellenbrown.com, and I have over 300 articles, or no, not over, almost 300 articles that I've written on this subject there. And my books are Web of Debt and The Public Bank Solution, both on Amazon, available on Amazon. And then I have 10 other books on other subjects.
Thank you very much for chatting with This Week in Money.
Thank you. Nice talking to you.
After the break, David Skarica on This Week in Money.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is David Skarica, publisher and editor of addictedtoprofits.net. Welcome to This Week in Money, David.
Thanks for having me.
People are paying attention to the stock markets. It seems every week we set new record highs, but why should people be a little nervous about things like the NASDAQ?
Well, first of all, to be honest, I never really thought we would get back this quickly to the NASDAQ 5,000. I thought that when the NASDAQ hit 5,000 back in 1999-2000, it was very reminiscent of the 1929 Dow parabolic blow off, and that blow off took about 25 years to take out. Or you look at the gold blow off in 1980, the same thing. That took about 27, 28 years to be taken out. So these things usually take 25 to 30 years. So I was looking at maybe the NASDAQ getting back to 5,000 about 10 years from now. But I think all of the liquidity injected into the system and the money printing has kind of inflated another bubble. And the reason that I would be very worried here is that, people are trying to say this isn't a bubble because it's not crazy. Because 1999, 2000 was completely crazy with pets.com and companies with no revenues trading at 10, 20, 30, 40, $50 billion market caps. And they're trying to say because, most of the newer kind of dot-coms or biotechs right now have revenues and don't trade at these completely outlandish valuations, even though they're high valuations. It's not a bubble. But if you actually look at the total market on a per stock basis, we don't have that extreme valuation, even though we still have high valuations in some of the high-tech internet stocks, etc. But we don't have extreme valuations. But the average stock, on terms of a median price to sales, median, price to earnings level, is actually more expensive. And the thing about 1999-2000 was, most stocks did not actually go up in 1999. It was just a handful of those tech stocks driving the major indices higher because they had such a high weighting. So actually, there were a lot of value in the market at that time if you looked outside tech. Like for example, auto repair companies are really cheap, gold, precious metal stocks are really cheap, etc. And a lot of emerging markets are really cheap. But now, because of quantitative easing, kind of the whole market's expensive. There's a few things here and there. We're going to talk about Russia a little later that are cheap, but for the most part, like the perfect example is, and I have no position in this stock at all, is you look at AutoZone, which is, a website that sells auto parts. Back in 2000, this was a $21 stock, and now it's a $650 stock, trading at a huge multiple. So you just don't see, and the reason I use that example is AutoZone did very well in the 2001, 2002 bear market because, people tend to replace parts in cars rather than buy new cars during an economic downturn. So it's usually a good sector as a way to hedge yourself in a downturn. But anyhow, you don't see that valuation, and AutoZone probably not a good hedge now because it is so overvalued and trading almost more like a .com type company. So, when you see, again, the median price to sales of an S&P 500 company at an all-time high, the market is not cheap. And then you look at things like, the two other factors I'm looking at right now is market cap to GDP. The stock market compared to the economy is about the second most expensive it's ever been, the most expensive again being 2000. And then the last thing is just actually the trading pattern itself. And actually on my website, I just put up a video about this and said that when you get this 3 to 4 year period where you go, you get two things. You get about roughly a double in the market in 3 to 4 years, and it coincides with not having any major corrections to kind of relieve the overbought pressure. Every time that's happened in the history of markets, you've always fallen with a bad bear market. But the problem is we just don't know when that's going to happen. And usually bear markets begin with, kind of like liquidity being taken away. Well, the problem is now is the Fed kind of wants to keep this going, the wealth effect, the higher stock prices going as long as possible. So we're not going to see a real tightening on the reins. And the market is kind of just have to correct on its own, which can happen. We've seen this numerous times in Japan, where Japan's had basically zero interest rates for 20 years now, but there's been numerous 40, 50% corrections in the Nikkei. So I still think we can get this major correction, but it's just a little more difficult right now when the authorities are not going to tighten it all.
How is oil connected to all this?
Well, I think oil's really interesting because I think it's almost like a warning signal for the stock market in two ways. Number one, just the price action. Oil was, I think, basically artificially being held up by all the quantitative easing and all the liquidity kind of holding up the price of that commodity, even though we saw a lot of supply coming onto the market, especially in the expansion and the oil sands of Canada and more so the fracking shale boom in the States. So that price probably shouldn't have been at 100, but QE kind of depressing the dollar and inflating certain asset prices helped keep that dislocation longer than it should have been. And so the forewarner there is, look at the way the price of oil just dropped off a cliff. It was $100 and 6 months later it was 50. So I think that's a warning to anyone in the stock market that when you have something artificially being held up by liquidity, look what can happen when that liquidity basically is no longer as large, or when the sentiment turns in that market. So, I'm not saying the stock market's going to fall 50% in 6 months, but what I'm saying is that is a definite warning sign. And then the second part of it is, part of the boom in cheap money was this boom in high yield energy. That many of these fracking companies and shale oil companies are funded with junk debt. Junk debt in these companies was, I think, about 4 to 5% of the oil market back in, of the total junk bond market back in 2003, 2004. And now it's about between, depending on the numbers you look at, 15 to 20%. So it's a much larger part of the junk bond market. And what's going to happen is when oil, when we've already seen it starting to erode a bit, as it continues to erode, and these companies, are going to have to basically pay higher yields on their bonds, et cetera, or may not even be able to issue junk bonds. I think it's going to filter through and affect the rest of the junk market, kind of maybe like, subprime did back in 2008. And then you could see a run in junk bonds. And of course, the corporate bonds go up in yield. Then companies can no longer borrow to buy back stock. And then that's kind of when the whole bull market ends. So it's kind of like oil triggering problems in the high yield market could be our trigger for what leads to the next major decline in the stock market.
Well, I've seen research that shows when oil takes a big drop, the stock market tends to follow about 6 months later.
Well, if that's the case, and we're looking at this spring, and I think we could start a decline in the next month or two. Part of the reason is near the end of bull markets as well, the market tends to get less leadership. And what I mean by that is what you tend to see is fewer and fewer stocks driving the averages. And if you look at this last move in the NASDAQ with this kind of NASDAQ 5,000 fervor or fever going on, right? You look at it, it's like Apple, Cisco, a handful of the large companies moving higher, and actually most NASDAQ stocks are not participating in the rally. And again, that's kind of similar to what happened in the first quarter of 2000 or what happened in October of 2007, both at market tops. So you get less and less stocks participating and only a few stocks driving the indices. So that could definitely be the case, and it could be like 2000 in that we begin to see a major break maybe sometime in the spring. And actually the thing I would watch out for, and this is something that I've just come to the conclusion of in the last few months, is buybacks are the major source of buying in equities right now. And, companies have a 5-week quiet period where they can't buy back stock ahead of earnings. So that means that the second month of the quarter, which is February, tends to be the largest month where these companies buy back stock. So we're seeing this pattern where in the first month of the quarter, while they report earnings, and this happened in late July, this happened in October, happened in January, the stocks sell off when that kind of buyback, cushion under the market is taken away, and then the market rallies as soon as companies can start buying back their own stock again. So if we get a large break in the market, say in April or in July or in one of these first months of the quarter, and then that the rebound when companies are buying back their own stock does not take us to new highs, I think that could be a real sign that the market is about to turn lower. And in terms of oil and gas, another thing that hasn't happened yet in that sector is, there's an old saying that the denial is more than a river in Egypt, right? And these companies, these banks, I'm short these banks, the big regional banks that have lent a lot in the energy sector, and I'm also short a few of the shale oil plays, because these companies have not done their write-downs yet. Okay, they've said we're going to stop CapEx spending. They've brought down their earnings numbers, but they haven't said, property ABC is now only worth this, and what's in the ground is only worth this, because oil is 50 or 60, not 100. So that's got to be the next shoe to drop, and that's what we've seen in all the mining companies do the last 2 to 3 years. So once it becomes something more apparent that this $40, $50, $60 oil environment is here to stay, rather than a $90, $100 oil environment, then you've got to see these write-downs, and that is when the balance sheets of these companies, which are already very weak, will take even a larger hit. And I think that's when you can see the bankruptcies, the inability to pay interest payments, and kind of the decline in the junk bonds of these companies.
We're talking to David Skarica, publisher and editor of AddictedToProfits.net. David, with the Russian stock market taking a pounding because of all the sanctions against Russia over the situation in Ukraine, is Russia maybe a place people should look to invest in since things are so cheap?
Yeah, I actually started looking Russia at about a year ago, about March or April of last year. I only took a couple of very, very small positions. And then really, I was just, one of those things where I was very patient. I was waiting for a capitulation or a panic. And I think I found it on December the 16th. And on December the 16th, I actually saved the cover of Bloomberg.com, because there were about 20 articles, all doom and gloom, all Russia's going into another 1998, all that the country is going to collapse, blah, 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 blah. And that was essentially the day the ruble and the stock market there bottomed. And I actually made probably about 80% of my purchases on the Russian market that day. And the reason that's kind of key is that many of these stocks, if you go look at the charts, you'll see kind of had an island type reversal that day where they kind of hit a spot that they haven't even gotten close to on the downside since. And many of these companies are already up 50, 60, 70, 100% in just a few months. So, but still, even with that kind of rally, we look at the combination of, if the ruble has now bottomed at 70 to the dollar, in U.S. dollars terms, even if the Russian market does nothing, if, the ruble sees a 10 or 20% rally from here, you're going to see a 10 to 20% rally in these companies in U.S. dollar terms. And then the exact valuations, these companies are extremely cheap. You're talking like companies like Lukoil and Gazprom, or they're trading a mid-single digit PDEs. Now, many of them are now going to get debt downgrades because, the Russian government is now rated junk by both S&P and Moody's, right? So that's going to hurt them as well. But I think most of that is in kind of the market. It looks like, despite what we're reading in the Western press, this ceasefire is a little more for real, that the Russians kind of took their positions on the eastern border with Ukraine, and now everyone's actually kind of toning it down and pulling it back a bit. And Russia kind of gotten what they wanted, because Ukraine is a total disaster economically. It's going into hyperinflation. It's going to need IMF bailouts. One of the only things that Ukraine had going for it was they would get cheap gas from Russia, and now the IMF is making them basically do a big tax on gas to meet the terms of these bailouts. So, essentially, Russia's kind of gotten what they want. And, this is where you have to look over your bias or look over what the mass media is telling you. And that, again, if you go to Bloomberg or Yahoo Finance or these kind of American outlets, what you'll see is doom and gloom and stuff bashing Putin and Russia every single day. But you'll see virtually no articles on Ukraine. And Ukraine is actually the real basket case, not Russia. So Russia's kind of already won in that regard, where, yes, the oil prices and sanctions are hurting the Russian economy, but it's not completely collapsing like Ukraine has. And what you have to ask yourself is, okay, Russia's going to contract 5 or 6% this year, okay? But they have 15% interest rates. If in Canada and the States we had 15% interest rates, we would completely collapse. So the Russian economy actually isn't doing that bad when you take into account the kind of rate hikes they're seeing, to protect the currency and the whatnot. So to me, it looks like you're going to see the stabilization. We could get one more leg lower in the oil market to $40, which will kind of wash out a lot of this excess supply in the market. And obviously that can mean one more leg lower for Russia or the Russian currency. But I think for the most part, the bad news is in, and the market is so cheap, you're not going to see a huge amount more downside in Russian stocks. And again, that kind of sentiment we saw on December the 16th when the currency smashed and the stock market was smashed was kind of reminiscent of, to me, of a major capitulation kind of bottom.
Does the Russian situation give us any hope that after bad times in Greece, their markets too could have a big uptake?
Well, Greece has been for about 3 years now a very cheap market. I actually bought in 2012, then sold out early last year, because I thought that the Greek market, or sold out the majority of my positions, because I thought the Greek market, the trade had gotten too crowded. Hedge funds started to really like it, and they were in all these Greek stocks, and and I got in a little early, about a month before the bottom in 2012, but I still sold out at a pretty good profit. So I started to get in after this news of the election and this left-wing party was going to get in power, et cetera, et cetera. Now, you've seen a pullback in the Greek stocks after kind of guarantee this money for about a 4-month extension. And I really don't think there's a huge amount of downside either way, because if they continue to get this kind of bailout money, it's going to stabilize the financial sector. It's going to stabilize Greece for a little while. And, I think some of the austerity will be loosened in the next terms coming up, and that will help the markets. And if you get the Greg said, and Greece has to default and leave the euro and all these things, you're going to see a huge devaluation in the drachma, which will actually help the Greek stock market, which is already so low and so depressed that actually at its low in 2012, it was down 95% from its all-time high. So I don't really see a huge amount of downside. It would be probably pretty bad for the Greek banks, but the actual entire stock market itself, Greece kind of having a trading / tourism kind of economy, that would actually probably help a lot of the aspects of the Greek economy. So I think under both circumstances, you're looking at a pretty good trade here. And you kind of had the buy on the rumors, sell on the news with this bailout. So I think now Greece looks very appealing after it's kind of sold off a few days after the bailout got approved.
I'm always wondering, though, if Greece defaults and the European banks have to, again, do what they call the Cypriot haircut and take money out of people's bank accounts, what kind of exposure do we have here in North America to that?
Well, I think that's already been done. I don't think that's going to happen because here's what's happened. If you go look at it, the Germans have already done what they wanted to do in that they have taken the majority of those deposits or their exposure to Greece off the German banks' balance sheets and put them on the balance sheets of the ECB and IMF. So essentially, you're going to get a little bit of write-downs and losses in these European banks, which could lead to some losses in the North American banks. But if you go look at what's happened is over the last, this is the whole reason for the Greek bailouts, by the way. Don't kid yourself that this was to bail out the Greek people. This was to bail out the banks in Europe. So essentially, what they did is that they moved this debt onto the IMF and ECB balance sheet, and the banks aren't really holding the bag as much as in Europe. So I don't think you're going to have that kind of problem. I think it would be a bigger problem for the Greek banks because they're going to see outflows, and they obviously own Greek debt as well. But I think even under that scenario, you would see China and Russia come in and kind of give the Greek banks the $5 to $10 billion, which, let's face it, for China and Russia is not a big deal. The money, especially the amount of money that you need, especially when you see the strategic positioning of Greece in the Mediterranean for both China and Russia. And by the way, that's the real reason I don't think that will happen, is that the ECB and Europe, from a political standpoint, knows that Greece is too strategic. You can't have a Russian, base in Greece right next to a NATO base, so that's why it's not going to happen, and that's why I think they're going to continue to kind of kick the can down the road and continue, giving Greece money.
David, how can people subscribe to your newsletter?
If you go to www.addictedtoprofits.net, you'll see I have a link there to sign up for my free publication, and you can also sign up for my newsletter and or trading service. And usually what I do to sign up for my free publication is, and I'm probably going to actually do one in about a week or so, is every month or two I have special offers to the newsletter where you get a discount or maybe a month or two bonus for free or some reports, additional reports. And, so if you sign up for that, you can get access to that. And, when I do one of these, promotions, you can sign up on a special deal.
David, thanks a lot for talking to us.
Thanks for having me.
My guest has been David Skarica, publisher and editor of AddictedToProfits.net. Well, that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Ellen Brown, and David Skarica. You can send questions or comments about the show to info@howstreet.com. I'm Jim Goddard. We're back next week with more This Week in Money.
This Week in Money is a production of How Street Media Incorporated.